I'm the owner of ANA Capital as well as the chief analyst. So welcome to our YouTube channel. This is our first video, which is going to be the Sunday market breakdown ahead of the new trading week. Normally we would give this to our clients, however we decided to make this public on YouTube, so feel free to avail of it. So if you're interested in what we teach you today in terms of Elliott wave theory and institutional trading and want to learn how to trade like us, feel free to head over to our website aacapitalltd.com and have a read about us. There's a link to our free Telegram channel and also read about the services that we offer. So we offer live trading, trades journal, forex course, and the one-to-one mentorship. This trades journal is really popular and is available to all our clients for free if they purchase any of our offers. With regards, if you have any questions, feel free to message us through this website and have a read about services and what we offer. So if you want to get more detail, just click read more and then you can just have a read about what we offer. And if you want to purchase the one-to-one mentorship or the forex course, you can purchase this through the website too. Okay, so now I'll head over to the market breakdown. So going ahead into this trading week, my two pairs that I'm looking out for are gold and GBPAUD. They're my two setups heading into this week. So I'll go over gold first and then I'll go over GBPAUD. So with the election coming up on Tuesday, there is bound to be volatility. So essentially, we at ANA Capital are not going to trade Monday, Tuesday, or Wednesday. We're going to let the market settle down and then we're going to trade Thursday. So yeah, just whenever you're trading, just make sure to include proper risk management and only trade what you're able to lose. So let's head over to the analysis for gold. With regards to gold, we saw this bullish move, massive bullish move, right? That ended on the third touch of this trend line. Typically we don't trade trend line, so we didn't execute this order. However, we saw this correction then, right? So we have, in terms of Elliott wave theory, we saw 5 impulse waves complete over here. After 5 impulse waves, or after 1 impulse wave, we see a correction. So we saw this ABC correction, this massive move. That created a liquidity void that eventually got filled. That liquidity void getting filled created an ABCDE triangle pattern, a contracting triangle. With regards to the ABC wave, how do we know that the ABC wave completed? Because we then saw this impulse move down. And we saw what, in terms of Elliott wave theory, what we like to do is the E wave likes to go back up to this trend line, or it typically likes to complete at the 0.618 or the 0.5 fib. So we saw this complete on the optimal trade entry in terms of ICT around 0.79 fib. Next, what we saw was this impulse move down, right? This was a massive impulse. So after this impulse, we saw this correction. This was a very large correction that has been going on for about 2 weeks or more now. What did we see? So we saw this impulse move down. So that's the wave 1 in terms of impulse. We saw this correction, wave 2. Okay. Next, we saw this massive move down. That is the third wave, which tends to be the longest wave in an impulse wave for Elliott wave theory. With regards to the subwaves of wave 3, we see 1, 2, 3, 4, 5. There's always 5 subwaves within the largest wave, which is typically the third wave. So, why is the full impulse not completed? Well, the full impulse is not completed because we have 1, 2, 3, 4, 5. That was part of the third wave. We still haven't seen this 5th move down, so which is why I'm still quite bearish in gold. Let's see. So after this correction, okay, we saw a move up, correcting. What's that? An ABC wave. How do I know it's an ABC wave? So if I head down to the 1 hour, what do I see? I see 2, 3, 4, 5. Then we saw this 3-wave structure. So A waves can either be 5 waves or 3 waves. If it's 5 waves, we call it zigzag, and if it's 3 waves, we call it a flat correction wave. So this was a zigzag wave, right? So we saw this A, B, C as part of the B wave, and then we saw the C wave. C wave is always an impulse wave, a motive wave, you could say. So a 1, 2, 3, 4, 5. This 1, 2, 3, 4, 5 wave was actually quite tricky. Why? Because it's an expanding wedge. So one of the rules for Elliott wave theory in terms of impulse waves is that wave 4 cannot come into contact with wave 1. However, what happened was, because this is an expanding wedge, wave 4 can in fact come into contact with wave 1. So it did, and then it pushed up. Now, what happened? We have this buy side liquidity resting here, okay? So retail sellers would all be selling, oh, resistance, selling, right? What was this move? This move was an encouragement for retail traders to get in the sell, thinking, oh, okay, what we're going to do is we're going to repeat this impulse down. But we're not actually going to repeat this impulse down because we still have not taken liquidity. We haven't taken all those retail orders yet. Then what did institutions do? Institutions took this sell side liquidity resting below here, triggered off this OB over here, pushed price up to catch out these retail traders. All these stop losses were hit, and then once we filled this fair value gap over here, we saw this bearish order block, and then we took this trade. After the retail traders got stopped out, then we took this trade. I personally moved SL to entry on this trade because I was up about 500 pips. I took profits after this massive move, so I think I took 50% of my trade off. Then once we went back up, I knew we were going to fill this liquidity void, which we did eventually. However, price still came back and unfortunately tagged me out at my entry by a small amount, a very small amount, like about 0.1 pip. But I know some of the guys in ANA Capital in our discussion group, which you can join for free on our Telegram, kept this open and are now up about 518 pips. So yeah, in terms of targets, for gold, we are still looking to target these equal lows. So over here, retail traders would be buying, meaning there's liquidity resting below this, meaning sell stops, and the buy orders is stop losses. So we're gonna all the moves are attracted towards liquidity. So we have liquidity resting here, so we're bound to attract here. We're bound to get price here. And then we could push up, but I'm still going to be looking to fill this fair value gap that we have over here. In terms of the 4-hour fair value gap, I expect this fair value gap to be filled because it fills with Elliott wave theory, this fair value gap, which is why I'm going to target it. Okay, that gives us a nice 26 risk to reward. Yeah, so what do we have now? Why am I still looking to get into this trade? Why am I looking to scale into this trade? Now, okay, what do we see? We saw this impulse wave down. So wave 1, 3, and 5 all consist of subwaves. Okay, this subwave, the subwaves of wave 1, 3, and 5 are all going to be impulse waves, and then waves 2 and 4 are going to be correction waves. So we saw this wave 1, okay? Then we saw this wave 2 form an ABC, so a flat, a 1, 2, 3, 1, 2, 3, then 1, 2, 3, 4, 5. Okay? Now, once the C wave was completed, that unfortunately tagged me out at entry and then fell again. So the crucial thing is that wave 2 can never exceed wave 1. So if wave 1 started here, wave 2 can never exceed it. So wave 1 was 1933.268. Wave 2 came to 1931 and then pushed down. So it still validates our impulse down. What do we see now? We see a wave 1, a wave 2, a wave 3, a wave 4 that never came into contact with wave 1 and wave 5. So we've completed our third wave. Now, remember I told you the rule for Elliott wave theory is that the wave 4 can never come into contact with wave 1. However, we are right now in the fifth wave, meaning we can be an expanding wedge, meaning that wave 4 can in fact come into contact with wave 1. Now, what do I expect to happen? Well, we have a liquidity void resting there. What have we also done? We've also taken out liquidity. A lot of traders would be looking to buy here, buy here, buy here. What did we do? We took them out. We took their liquidity out, right? We caught liquidity, their sell stops were triggered, then the original move happened. So what am I expecting? I'm expecting price. We already saw the orders mitigated and then triggered, so I'm expecting price to continue higher. Until where? Well, we have liquidity resting here. Remember, price is always attracted to liquidity. What do we also have? We also have a bearish order block resting there with an optimal trade entry of 0.5 fib of the order block. So we have a larger order block with a smaller order block in between, and that corresponds with 0.5 fib. So I'd be looking to trade this trade bearish because we've taken liquidity, then the original move happens. So where would I place my stops? So typically I would go down to the 1 minute and then modify my entry to fit my entry criteria. And for gold, I'd look for about a 20 or 10 pip stop loss if possible. If I see it on the 1 minute, if my entry criteria is filled. And then where would I look to target? I'd look to target over here, the fair value gap. That's a really nice 50 to 1 risk to reward. Risk 2%, get 100% of your trade back. However, if I'm not in front of the charts, I just set a limit order for my 0.5 fib and then put my stops above the wick of the order block. Okay. So yeah, that's gold. So what am I expecting? So I remember third wave is always going to be correction wave. So I anticipate this is wave 1, wave 2, wave 3. Sorry, wave 1, 2, 3. So it's an ABC. Then we have a B wave. Now we're in the middle of a C wave. A C wave is always an impulse wave. Okay, so where do we go? We go back, trigger this remaining orders, go over here, attract this liquidity to sell, retail traders, take out their stop losses, and then finish off the expanding wedge by reaching all-time lows. Not all-time lows, just filling the fair value gap. So that corresponds with Elliott wave theory and it corresponds with ICT. So I'm definitely high probability on this setup. Next thing I would be looking to do is, I'd be looking to scale into this order. Where would I look to scale into this order? After we take out liquidity, what we're going to do is we're going to come back and break even by the manipulation that institutions will do. I'll scale in there and then all the way down. So I hope you benefited from this gold trade. Next setup that I have is the GBPAUD. So GBPAUD. This is quite a nice setup as well. We can see why retail traders never win. We can see why 95% of traders lose money. 95% of the traders, they trade support and resistance. It's called retail, but we don't know how the banks make money. So if you want to learn how we trade, how we get these high probability risk to rewards of like 50, 20, feel free to go onto our website and then you can sign up for our course there with mentorship or our educational course, or you can join our free Telegram channel, and we also provide daily updates there with the setups that we're looking to take. So next thing is GBPAUD, right? So let's go and let's see what we're on about here. What do we see? Okay, from this overall view, what do I see? Equal highs, right? What are retail traders going to be doing? All these sell orders were retail traders getting in the market. Oh, let me sell. But retail traders never win. You should know that. 95% of traders lose money. Why? Because they don't know how the banks trade. What did institutions do? Manipulated the markets. Triggered the buy stop, of the retail traders, which was resting above resistance. And they also stopped out their sell orders. Okay, then the original move happens. This is one of our classic textbook setups. Market structure break. The impulse move down was a market structure break. Okay, so we broke market structure. Then an RTO, a return to origin to trigger these orders. Okay, so that's what we saw this massive wick was about. That massive wick was all these orders getting filled by institutions. Okay, next thing is Elliott wave theory. So we're in this massive ABC correction. Okay, so what happened was we have an A, we have a B completed. So an A here, a B, and then this massive impulse. This A wave was a 3-wave structure. This B wave was a 3-wave structure. The C wave was a 5-wave structure. Very simple. Okay, Next thing, once we completed the ABC wave, we saw this impulse. Okay, that impulse was part of the larger C wave. Okay, so this ABC was a 3-wave structure as part of the smaller B wave, as part of the larger B wave. And then once we completed the larger B wave, what do we see? We see an impulse. Okay, so this is in the wrong position. 1, 2. So this was our impulse up, retracement. What did I say? The third wave tends to be the longest wave and consists of subwaves. So we saw 1, 2, 3, 4, 5 subwaves within the third wave. Okay, see how it's easily identifiable? Next thing we saw was a retracement for the fourth wave. For the fourth wave, we saw an A, a B, and then a C. Okay, then we saw, once we completed the fourth wave, we saw this impulse up. 1, 2, 3, 4, 5 to finish off the massive C wave. Now, what we'll do now is we will continue bearish because we've completed the correction wave. How do we know that? Look at this impulse. Wave 1. Now this retracement to collect the unfilled orders is wave 2. Okay, wave 3 will consist of subwaves. That's what we're going to do. That's what we're in right now. We're in the subwave of the impulse down. So we completed this first impulse wave, right? A, B, and then we saw the C wave, right? What are we going to do now? We're going to push down. How do we know? Look at this impulse. All these remaining orders at this bearish order block was triggered. So we saw this 1. Now we're in this A, B, C wave. Okay, so what are we going to do now? We're at a level of retail traders. We're going to attract them to sell, sell, sell. That's going to be our third wave of our C wave. And then we go push up, take out liquidity, grab the unfilled orders, and then we push down. Now, in terms of the accurate prediction, because this is what? Wave 3 always consists of subwaves. So we go wave 1, wave 2, okay? To trigger the unfilled orders. Wave 3 will be to these equal lows resting here. What are retail traders going to be doing? Oh, support, let me buy, let me buy, let me buy. Then we go to this breaker. This breaker will then push price all the way down to trigger out these equal lows. So in terms of targets, this is where I'm resting. What did I say? Third wave always consists of subwaves. This subwave, so let me just change this. So if I consider this a sub-microwave, this will be a wave, this will be the subwave of wave 3. So wave 1, wave 2, wave 3, wave 4 on this breaker, and then wave 5. Okay, I'm just going to make this a different color so it's easily identifiable. Let's see, let's make it this color. Okay, so see how easy it is. It's just understanding, not trade with retail. Okay, just don't trade with retail and you're fine. So equal lows. Okay, we have this liquidity void over here. What do I mean by liquidity void? A liquidity void is an imbalance in the market caused by institutions. So this liquidity void was not filled. We could consider it a fair value gap, but on the 1 hour it's a liquidity void. So I would expect this to be filled. Yes, I might see a push up of this, but we still haven't taken out liquidity, so I'm definitely expecting price to push below and take out that liquidity. In terms of a larger target, you could also look to take out these equal lows. Here, what risk to reward? 42. Over here, you're not getting the best risk to reward. Oh, well, actually you are, yeah, 25.75. In terms of entry criteria, 1 hour, what did I say? We're encouraging retail traders to sell. What did we do over here? We saw equal highs, institutions manipulated because these retail sellers were selling at a double top, manipulated, market structure break, same again, RTO, return to origin over here. This was the larger return to origin, now this is a smaller return to origin. We broke market structure over here. We're getting a return to origin to trigger unfilled orders. Once these retail sellers get manipulated, we're going to push price up, trigger the unfilled orders of institutions, and then push price all the way down. In terms of our entry criteria, I typically go to the 1 minute. No, you're not going to figure out here on this 1 minute on this video. All these entry criteria that we have will be available in our course that you feel free to take and purchase on our website once again. And then what we do is we look for our entry criteria in the 1 minute. We know this is an area of interest. Typically on GBP pairs, we get around a 7 or 8 pip stop if we're in front of the charts. If we're not, once again, our limit order gets triggered. But if we get a 7 to 8 pip stop, what would our risk to reward give us? 7 to 8 pip stop. Okay, let's say 10. Okay, 10 pip stop, 50 risk to reward. Once again, risk 2%, get 100% of your account back. This is what you get with Elliott wave theory and institutions. There is not a better combination. Elliott wave theory and institutional trading will literally make you a master of the markets. Like, I've not been trading like for 15 years as all these retail gurus say that they've been trading for and that are apparently making money. But I mean, at the end of the day, they're not the market makers, it's the institutions with like billions being injected, billions being injected into the markets. So follow institutional trading and Elliott wave theory and then you're sorted. So yeah, that's my market breakdown. If you have any questions, feel free to go onto our bio and join our Telegram channel or message me directly on Telegram using the username Ahmed_AshFX, which will be in the bio. But yeah, hope this helped you guys, and yeah, best of luck in your trading, and watch out for our trade recap at the end of the week, and then our Sunday market breakdown once again next week when we will be trading from the start of the week once again.
Is the Euro-Japanese yen. The Japanese yen gained a lot of strength last week due to the US elections in the upcoming week. The euro, on the other hand, went down. The Japanese yen gained a lot of strength last week due to the US elections this week, and that's why a lot of investors will be putting their money into the Japanese yen. The Japanese yen is considered a safe haven by a lot of investors, and that's one of the main reasons why people will be putting their money into the Japanese yen, and the euro, on the other hand, is not considered in the same way, which would make the euro push down. So the Euro-Japanese yen is a really nice trade that will be taken this week. Let's just push into the weekly to see a better overview. So as you can see here, we have a really nice bearish engulfing candle. It has broken through equal lows very impulsively. As we can see previously, that the previous weekly higher highs and higher lows were broken straight away. Higher highs, higher lows were broken straight away, forming equal lows now, forming equal highs now. Equal highs is a price where institutions try to push up and above it before breaking below. Let's just push into the daily for closer insight. So yeah, as we can see on the daily, that 1, 2, 3, 4, 5 last week was very impulsively down. There was not much of a drawdown and there was no green candles, as you can see. So we can kind of see a head and shoulders forming here, with this being the left shoulder, the head and the right shoulder. This is really nice and adds into our confluence, as a head and shoulders pattern is usually a reversal pattern. So we can see movement to the upside since May, a head and shoulders forming, and then price pushing straight back down. This shows us that price is going to come back down, probably to around here, to these equal lows. We can also see that price did retest, and then now equal highs have been formed. Equal highs are formed, and institutions usually break above these equal highs before bringing price down. But here we can see that institutions did not. They just respected the equal highs and brought price back down. This is not what they like to do against retail traders, as this causes retail traders to win. Why? Because here we can see equal highs have been formed. Equal highs. So we can see a double top being formed. One there, one, that's the second one. Just get rid of this, make it easier. So yeah, a double top has been formed, 1 and 2. This double top has been formed. Institutions know that retail traders can see the double top being forming, and that's why they usually break price above these double tops, knock out SL hunts of all retail traders before bringing price back down. But here institutions let the retail traders win. This is following price back down, but here we can see the Friday candle was not very clear. A lot of indecision was created on Friday, so that makes me believe that there could be a retracement on for next week. It's not 100%, but obviously we're going to be using the lower time frames to see about the retracement. Let's push into the 4 hour for a clearer view. So here we can see in the 4 hour chart the price is at the 121,800 mark at the moment. If we draw our fibs from when we drawing them from here to the price where it is at the moment, we can see that the 30 to 8.2% level is perfectly at these equal lows. Personally, I look for deeper retracements into the 50 and 61.8%, but if we're on the daily right now, let me push on the daily, 38.2% is a deep enough retracement regarding the daily. If we push impulsively higher above that, we might push into the 61.8%, which is also a key level. This is much more easier to look for a downside trade, as a lot of more confidence is lying on that. But if it pushes up to the 38.2% level and rejects the level and pushes straight back down, it's also possible due to the elections only in 2 days. So maybe Monday price pushing a bit up, Tuesday big impulse up, rejecting 32.8%, and price moving straight back down to near the end of the week, where we might see price maybe come down to here 119. That is at 200 pips on offer. JPY is considered a safe haven, so price could be pushing back down. Let's push into 1 hour. So we can see a large OB has been created here. Topping tail has been created as well. If price is to come back into the 61.8%, we'll be seeing a lot of impulse moves early on in Monday. If price comes up to this 32.8%, which is these equal lows, retests them and pushes back down, we will see a really nice trade leading up. SL just being above previous with a risk ratio of 13.11, and if price comes up to 61.8%, our risk ratio is not 12.22.
Hello everyone, this is the euro dollar on the weekly chart, and what I'm seeing right now is that the price for last week has just closed as a bearish red candle. And what's interesting about this is that this candle closed as a bearish engulfing on a bigger time frame. This bearish candle has engulfed this bullish candle, which means that the bears are in control of this market on the euro dollar. So what I'm anticipating right now is for this week going forward, that I'm anticipating price to continue to move to the downside all the way up to around this location right here, where all the unfilled buy orders are located. And what I'm expecting is for price to drop, to keep on dropping all the way around down here, and then shoot right back to the upside for these next couple weeks. What that will mean is that as price continues to drop, the dollar will be getting strength. So I'm anticipating that price will continue to drop to the downside, all the way up to around this area right here, where all the unfilled buy orders were created by banks and institutions, and then shoot right back to the upside around this location right here at 1.13250. Yeah, 1.13250 around this location right here. I'm expecting where price will turn around and move to the upside. And like I said before, this is a bearish engulfing candlestick pattern where I'm anticipating price to shoot down starting this week and going forward, despite the election we have coming up this Tuesday. So yeah, so this is south side right here where all the unfilled buy orders are located, and then our north side is around this location up here to the upside where the unfilled sell orders are located. It's an area where both locations are fresh, where unfilled orders have been created and has not retraced yet. So let's look to the daily right now and see what we have and how I will know that price will start continuing to go in outside. So yeah, as you guys can see here, you see a high. You see this area. Sorry about that. You see this high right here, this highest point of the chart, lower than this highest point right here. You do your trend lines, you'll see this. And also, as you notice as well, price went through this area of support right here. Now it has to go through this, which it will easily go through, because this area for a buy is not authentic. This area for a buy was a reaction off of this right here. It was a reaction off of this unfilled order here that banks and institutions went back to and collect, like it did right here, and turned around. So I'm anticipating price to break through this area right here of support. I'm gonna show you guys right now in a sec what I'm talking about. I'm anticipating price to drop right here, to keep on falling, then retrace back up for a bit around here, retrace back up, and then boom, start falling. So that's what I'm anticipating, what's gonna go on these next couple of days, along with election coming up. And if we look at the dollar index, you'll see that it's the opposite. You can see how they're both correlated and in the exact opposite. You see how we looked at euro dollar, how it was dropping. Here we see the dollar index rising, because the euro dollar and the dollar index are inverse, have an inverse relationship towards each other, as you can see. As you can see right here on the weekly for the dollar index, this week that just passed, it created a bullish engulfing, which is the opposite of what we saw with the euro dollar, where it created a bearish engulfing, because this bullish candle right here, this green bullish candle, it engulfed this bearish red candle, which means that the bulls are in control of this market on the weekly. And like I said before, we're in the middle. We're in the middle of the map. Like this is the north side right here, where all the unfilled sell orders hasn't been collected yet. That price has to go back to and collect. And then this is our south side right here, where the unfilled buy orders are located here, where banks and institutions left their unfilled buy orders. And as we can see on the daily, we can see the opposite right here. We can see the lows right here. We can see the low right here is higher than this low right here, and we can do the trend line. Trend line location right here. Trend on, and then we can see price right here. It broke through this high right here, and I'm anticipating for price to continue to go up and break through this high right here. And what I just did here is I created a trend line. I created two trend lines of resistance right here to show you how price broke through this high right here, which means that there's no unfilled sell orders located here, and also how I'm anticipating price and the dollar index to continue to rise and break through this area of resistance, because this area of sell is not authentic. What I mean by that is that it's not an origin level where price began to drop. This level right here is just a reaction off of this right here, where banks collected their unfilled sell orders right here and had price turn around at this location. So when it goes back again, it has a higher chance of breaking through this high right here and collect the unfilled orders that are further up at this location right here at 96.2 or 0.02. I mean, sorry. So yeah, so that's what I'm expecting for the week. But since there's election coming up this Tuesday, I would advise people to be very careful with looking for trading opportunities and just look for confirmation. Just look for confirmation like how we did on a weekly. Like look for your bearish engulfing, look for your bullish engulfing, etc. Make sure you find those confirmations before you get into any trades. And make sure you risk a very small amount of your capital. And that's about it. And I wish everyone a great trading week and wish everyone all the best of luck. Take care.